and this is probably the first time that you're seeing me. So I'll begin by introducing myself, and then I'll introduce the topics that we are going to cover in today's session. Um, Begin with my introduction. So as you can see, my name is Waqar Ahmed. I recently joined the business school at the beginning of this year. Before this, um, I worked at Warwick Business School for like 5, 6 years, and I have a background in accounting and finance, undergrad in business administration. Then I have an MBA degree. After that, I worked in the corporate sector for some time, and then I decided that uh, I want to be an academic, right? Because I want to be young. So one of the ways to remain young is to be, or it's, if you are among young people, then you feel young, right? So I decided to join academia, and then I did my PhD in finance from Warwick Business School, and then I got an offer from there and worked there for a few years before starting here. Right, so that's about me. And before we look into this, we look into the topic that we're going to cover today. So let me just quickly tell you how I want to run my sessions. So feel free to ask questions at any point in time. You do not have to wait for me to finish a point or finish something that I'm saying. If you have a question, feel free to interrupt me. Okay? Yeah, feel free to interrupt me. I'll be more than happy to interrupt me, right? Because I want to make sure that we are on the same page. Something that I'm saying or something that I'm telling you, you're following it, right? So feel free to ask questions at any point in time. Wherever you have any question, just feel free to stop me. So here I've listed my research interests. So my research interests exactly match the topics that I'm covering. So I'm interested in payout policy. So we'll talk about, so this section is about payout policy, right? So that's what we are going to cover in today's session. And I'll tell you what all about payout policy. And we'll talk about some of the research that's been done in this area. I'm also interested in executive compensation arrangements, basically how top executives are paid, whether they should be paid in cash, whether they should be paid in equity, right? Or a combination of these. I also work in insider trading, so I look at how insiders trade and whether those trades are informative for us, for outsiders, whether we can learn something, whether the market can learn something by knowing about how insiders are trading. So I also look at corporate disclosures and fraud and stock market efficiency and any anomalies that we see in the market. So in terms of my activities, I like to read, you could guess, right? And then I like to play cricket and squash. Right, so this is the topic that we are going to cover in today's session, payout policy. So far, so in this session, we'll look at free cash flows and cash distribution. So I've listed some of the things that we'll cover in today's session. So cash flows and how those cash flows are distributed to investors. We'll look at types of payouts. I've listed two of them, dividends and stock repurchases. So we'll talk about dividends and repurchases. We'll look at payout policy in practice, so what firms actually do. We'll look at alternative payout policies and how do payout policy affect shareholder wealth. So this is something that you know all the decisions that we take in a firm, the key objective is to maximize shareholder wealth, right? So we look at whether payout policy affects shareholder wealth. If it affects, then we need to pay attention to it, right? If it doesn't affect shareholder wealth, if it doesn't change firm value, then the question would be, why would we care about payout policy, right? So you must be familiar with Modigliani and Miller, right? So you must have learned about it when you learned about capital structure, right? So they have done some work. It's very similar to what you have learned in capital structure. So they have also worked on dividend irrelevance hypothesis. And then we'll look at some of the payout policy theories and whether it matters. Lastly, we'll look at buyback repurchases. So buybacks and repurchases in this session, we'll use them interchangeably. So they mean the same thing. So we'll look at the buyback anomaly. Right, okay, so what have you covered so far in this module? So corporate finance mainly deals with three types of decisions, right? So what are those three types of decisions? Can anyone recall? So you have like 8 sessions so far, right? So in those 8 sessions, if we talk about the financial decisions that managers make in a corporation, we can, from a corporate finance perspective, we can classify them into 3 broad categories, right? Can you name any of those? Anyone? Very good. The first one is corporate investment decisions. So corporate finance deals with 3 types of key decisions. The first one, investment decisions. Where should we invest, right? Where should, what types of projects should we choose, right? So the first key decision that managers have to make in a corporation is where they are going to make investments. What type of projects will they choose? And what have you learned in this module? How do we make this decision where we are going to invest? We use some tools, some techniques to help us decide which projects we are going to choose. Right? What do we call those techniques? Capital budgeting techniques, right? So in capital budgeting techniques, you have learned more than one technique, right? But theoretically, the most sound technique that we have is the NPV, net present value, right? Okay, so we make decisions which projects to choose based on NPV rule. What is that NPV rule? If the net present value of a project is positive, it means it adds value to the business, right? So we accept those projects. If NPV is negative, we reject those projects. Okay. So the first set of decisions we have to make is in terms of which projects to choose, right? Investment decisions. Okay. So what's the next set of decisions that we make? Yeah. Capital structure work. Very good. The next set of decisions, right? Okay. Good. Very good. Okay. So the next set of decisions that we have to make is about financing, right? So here, the investment requires where we are going to invest, right? But the next question would be how we are going to finance that investment, right? So in order to make investments, we need to raise some finance, right? Then how we are going to raise finance for those investments, right? So, and you have learned in this module that our financing decisions, the generic term that we use is we call it the capital structure. How the firm is financing, how the firm and its assets are financed. So then we have 2 main sources of long-term funding, which are equity and debt, right? So if we are going, let's say we have a set of projects that we want to invest in, then we decide how we are going to fund those projects. We can either fund those projects by borrowing, which we call loans or debt, or we can finance those by raising equity, right? And equity is what? Equity represents the ownership stake in the firm, right? It's the owner's investment in the business. Good. Okay, so you know all about this, right? So far. So the third key decision that managers have to make is how to reward these investors. So in the first stage, we decide where to invest. In the second stage, we decide how to fund those investments. And the third one would be those who are funding these investments, how should we reward them? What should be their return, right? Okay, so this third set of decisions is what we call the payout, deals with this payout policy of the firm. So how to pay out profits back to investors. You made investments, you generated some return. Now the question is, how are you going to share that return with your investors? So that's what we call the payout policy. Okay, so let me just quickly check what you know so far, right? So we know that we have two main types of investors in the business, right? Cash investors who provide that to the business, right? And then we have equity investors, right? Who invest in firms' equity. So what is the return to debt holders? Interest. Very good. So interest is the return to debt holders, right? Why someone would provide us with a loan? They need to have some sort of return, right? And the return that they get is in the form of interest, right? Good. So interest is the return to debt holders. Good. Very good. So you know this, right? What is the return to other investors? Equity holders. The return to equity holders is dividends, right? Is that right? You sure? The return to equity holders is dividends. Very good, right? So dividend is true. Dividend is only part of the return, right? Equity holders also get return in the form of capital gain, which is the change in prices over time, right? Change in share price over time. So the return to equity holders, one part of the return is dividend, right? Which you all know. And the second part of the return is in the form of price changes, right? If the price of the share that you have bought, if the price appreciates, right, the change in price, the increase in price is also your gain, right? We call it capital gain. So the return to equity holders is in two forms: dividends, and we'll talk about what dividends are, how these are paid, and the second part of the return to equity holders is in the form of changes in share prices, which we call capital gains. And if the price decreases, of course, you'll have capital losses, right? Good. Okay. Good. So before we look into payout policy in more detail, just to provide you with a context, and then we can try to relate some things that we are going to cover with this example. So until 2000, so you all know Microsoft, right? Anybody who doesn't know Microsoft Corporation? Everybody knows it, right? Good. Okay, so it's one of the largest firms in the world. But until 2003, Microsoft did not pay a single penny in dividends, right? If Microsoft did not pay a single penny in dividends, then why should someone invest in Microsoft, right? Because as we know by now that the return is in two forms. Although the firm did not pay any dividend, there might be return in the form of share price changes, right? Okay, so until 2003, no dividends. And it started paying dividend in 2003, and the starter dividend was 8 pence, right? What is 8 pence? Like nothing, right? Absolutely nothing, right? Such a big company paying only 8 pence as dividends, right? But in July 2004, Microsoft stunned financial markets by paying a special dividend of $32 billion. That equates to $3 per share. So we start a dividend of just 8 pence, and the following year, it made a special dividend that amounted to $3 per share. And since 2004, Microsoft repurchased substantial amount of its shares. So starting from 2004 onwards, Microsoft repurchased over $140 billion in share repurchases and raised its quarterly dividend 12 times. But 12 times of 8 pence is how much? Around 50 pence, right? Still less than 50 pence. Okay? So the company spent a lot on share repurchases, but still pays a small amount of dividend. So you can see in this example, in the case of Microsoft, right? In the case of Microsoft, the company does not pay a lot of return in the form of dividends, right? If it does not pay a lot of return in the form of dividends, then we can assume a lot of return would be in the form of changes in share prices, right? Another form in which company can return cash back to shareholders is by repurchasing shares. So let's say I'm the manager of Microsoft and all of you are shareholders in the company, right? So the way I can return cash to you is by paying a dividend, right? Or what I can say is I'm going to repurchase shares. So by paying cash, you will sell me shares, I'll give you cash, right? That's another form of cash distribution. Okay, we call it share repurchases. Okay, so what do we have here? So let's say if there is 1 million in profits, if the profits are $1 million, how do managers use it in order to maximize firm value? So here we're talking about the profit, right? So we made some investments, we financed those investments, now we end up with a profit. The question is, how are we going to share this back to share this with our investors? Which deals with firm's payout policy. So we have some free cash flows. What does the firm do with these free cash flows, right? So if the firm has generated some cash flows through its operations, what at the end of the year, what firm can do with it? The first choice is it can retain this cash flow and would like to retain this cash flow if it has good investment opportunities, right? So if there are other good investment opportunities, firm will retain this cash flow and invest into new projects, right? Or it can increase its cash reserve, right? That's what's going to happen if the firm does not pay this cash flow back to its investors, right? So firm will retain it, and there are two main objectives of retaining the cash flow: either to build up its cash reserves, right, or to use these cash flows to make further investments in other positive NPV projects, right? Because we know if you invest in positive NPV projects, firm value will increase, right? Okay. And the other use of this free cash flow could be to reward your investors, right? So the firm can pay this free cash flow back to its investors. And here we'll mainly talk about equity investors, right? Because the return to debt investors is in the form of interest, which you must pay, right? You cannot say that you can't pay interest, because if you don't pay interest, what will happen? If you don't pay interest, what will happen? You go bankrupt, right? Okay. So you must pay interest. So here we'll mainly talk about return to equity investors. So you can pay this free cash flow to equity investors mainly in two forms. You can pay it out in the form of cash dividends, or you can pay it in the form of share repurchases, right? So the example that I gave you, if I am the manager of a company and you own shares in the company, you can get cash by selling your shares, right? Good.
Excuse me.
Yeah.
Increasing reserve, increasing the cash reserve.
Yeah.
It's what I don't really understand. What was the increase in cash reserve? I was thinking maybe we'll just keep it in the bank, just keep it in the place, in a safe place, so as to increase our reserve.
Yes. So when you put it in the bank, it's a business bank account, right? So that's the cash that the bank that the business will have, right? Of course, it's in a bank. It's not like a huge sum of money sitting somewhere. You put it in a bank, but it's a business bank account. So so in the financial statement, when you prepare firm's financial statement, what do you say? Cash and cash equivalents, right? Which is the firm's assets. So that appears on firm's balance sheet as that this is the amount of cash that the business has. So business's cash reserves go up, right? Good. Okay, good. All right. Anything else? No. We're good so far. Good, good. Right. Okay. So we know that there are two main forms in which the firm can distribute these free cash flows back to its equity investors. Yeah. Okay, good question. I don't know whether this is just like what I'm thinking about. Right, okay. So what she's saying is she don't know, she's not sure at the moment. So when you repurchase shares, what will happen? The number of shares outstanding will decrease, right? Yeah. When the firm repurchases shares, total number of shares outstanding will decrease. So what she's concerned about is what will happen to the price. If you repurchase shares, number of shares decrease, what will happen to the price of the remaining shares, right? We will cover this, right? Okay, we will cover this in today's session. Just stay with me, all right? Okay. Okay, let me just ask this. What do you think will happen to the price? Just let's guess, right? At this stage, it will be guess, right? Yeah.
I think the demand will increase, that's why the price is also will increase.
Sorry, say that again.
I think the demand will increase because number of shares will decrease, which will lead to the increase in the price.
So because the number of shares you think because the number of shares have decreased, so the price of remaining shareholders will increase, right?
Yeah, I mean demand will increase.
The demand.
That's why the price.
Okay, good. So the demand for those shares will increase, right? As a result, we expect the price will increase. Okay, good. So I did tell you at the beginning that you can ask me questions at any point in time, right? Yes, which you're more than welcome. But I forgot to tell you, if we are in a session, right? If I'm talking or one of your colleagues is talking, then you can't talk to each other. Okay? All right. So no talking among yourselves. You're free to talk to me, okay? But not among yourselves. So one of you thinks that the share price will increase because the demand for remaining shares outstanding will increase. Any other guesses?
I think it has different theories to explain sorry. I think there is different theory to explain the case because it may be the case of imperfect market or perfect market. So it depends on the theory.
Okay, so she thinks it would depend upon the type of market, whether we are in a perfect market or an imperfect market, and that will determine what will happen to the share price, right? So conditional on market, the status of market, right? Or the type of market we live in, whether it's a perfect market or an imperfect market. Any other guesses so far? So basically there are like three options, right? So price will increase. The other option could be price will decrease. And the third option is that nothing will happen to the price, right? Price will remain unchanged. Yeah. Okay. So the reason I ask this question is so that you start thinking about it. And as we'll cover the remaining part of this, as we'll go through the remaining part of the session, you will have the answer to this, right? Good question. Okay, good. So payout policy, we also call it the dividend policy, tries to answer two questions basically. What should be the size of distribution? How much cash, so size of distribution, how much cash flow should you pay out? And the second question is, how should you pay those cash flows, right? So the dividend policy tries to answer these two questions. How much should you pay and how should you pay? So size and pattern of distribution. Okay, so what proportion of profit should the corporation pay out to its shareholders? So this could range from 0 to 100%, right? So company could pay 100% of its profits back to shareholders, or it could pay nothing, or it could pay something in between, right? So how it should be, so the second part of this payout policy is how this distribution should be made. So how this cash flow should be distributed, we can distribute it by dividends, or we can distribute it by repurchasing our shares. So what do firms actually do? So how much profit do they actually pay? What do you think? 5%, 10%, 50%, 100%, right? It could be any number from 0 to 100%, right? And then what do firms actually do in practice in terms of how they decide to pay? Whether they should pay through dividends or whether they should pay through repurchases, okay? So the key question for you basically is, what you should keep thinking as we go through today's session, is whether the way we make these distributions affect firm value. If it does affect firm value, then we need to pay attention to it, right? Because then we need to decide which form and how much distribution will maximize firm value. So we can think about this as so you learned about optimal capital structure, right? You're familiar with this term, optimal capital structure. Yes or no? Yes, right? So similarly, so what is an optimal capital structure? The proportion of debt and equity that would maximize firm value, right? Similarly, if the payouts affect firm value, then we can form an optimal payout policy, right? We can decide how much to distribute. We can also decide how to make those distributions. So we can choose an optimal payout policy if the method and the amount of payments affect firm value. So what do firms actually do in practice? So here are some statistics for you. On the top, we have percentage of firms that pay dividends only, right? Whether firms pay dividends, and then on the left, we have firms that repurchase shares. Okay, so you can see nearly 24% of firms do both. So they use both dividends as well as repurchases to distribute cash back to shareholders, right? So 24% of firms use a combination of dividends and repurchases. 23% of firms pay no dividend, but only repurchase, right? So you can see it's quite a distribution, right? Firms that use both, firms that use one, firms that use the other, right? Firms that pay dividends only, firms that pay that distribute through repurchases only, and then there are firms that do not distribute at all, that neither pay dividends nor do any repurchases. What's the percentage of those firms? 40%, right? So 40% of firms neither pay dividends nor do any repurchases. So you can see there's a lot of variation, right? in how firms distribute cash back to shareholders. So this is based on data of non-financial firms over the period 2011 to 2020. Okay, so this graph basically shows the combination of debt and repurchases. So on the left-hand side, on the vertical side, we have the amount that's been distributed, and horizontally we have time, years, right? And it tells you how much amount has been distributed per year in the form of dividends as well as repurchases, right? So dividends are represented by blue color and repurchases are represented by the red color. So what can you see? What can you learn from this graph? So what are the things that you can notice? Okay, so one of the things that you should notice is that the proportion of cash distributed through repurchases has increased over time, right? Red bars have grown in size. Anything else? Good, very good. Okay, the first thing that you should notice is the amount of cash that's being distributed. How much cash is being distributed per year? So let's say in 2015, for example. How much? Nearly 800 billion, right? Wow, that's a lot of money, right? Okay. Good. So these numbers are in millions of dollars, and we have like 800,000 million dollars being distributed just in 1 year, which is 2015, right? That's a huge, huge amount of money. Okay. So we know that firms do distribute a lot of cash, right? Although we have seen that only 24% of firms do bond repurchases and they pay dividends. And here, so we can see that over the years, so in the first, if you look at the early period, dividends were higher than repurchases. But as we move along the time, the amount of money distributed through repurchases has surpassed the amount of money that's been distributed via dividends, right? So what's the conclusion here? That over time, repurchases have gained more popularity, right? A lot of firms are paying cash back to shareholders in the form of share repurchases. But you should also notice that dividends haven't actually decreased. Dividends are also increasing. But in relative terms, repurchases have grown at a much higher rate, right? Okay. Good. Okay, so here I have some international evidence for you. So you can look at different countries and how much cash they are paying through dividends. So the first column lists the country. The second column shows the dividends as a percentage of cash flows. And the third one is the dividend as a percentage of earnings. And the fourth column is dividend as a percentage of sales. So if you look at this, you will see that the dividends that's been paid across countries varies substantially as well, right? So firms vary a lot in terms of how much do they pay in the form of dividends. So Taiwan, for example, pays the largest amount of cash flows in the form of dividends, right? As a fraction of your free cash flows, for example, right? And which company pays the least? Canada. No, South Korea, Canada, right? So you can see there's a lot of variation across firms. Right. Okay. So it's something that we learned in the earlier graph, right? So we have seen here the dividends, although they are rising, but in relative terms, share repurchases are increasing at a much higher rate. So repurchases are gaining a lot more momentum. So this is another graph that shows you a similar picture. So at the bottom, I have a link to this study from where I've taken this. So I would recommend that if you do have time, you go through this, right? So in this graph, what do we have? We have aggregate dividends and buybacks paid by U.S. firms, and the percentage of firms which pay positive dividends and buybacks. So what can we see in this graph? So dividends are represented by light blue color and buybacks represented by dark blue color. All of these amounts are in billions of dollars. So you can see in the earlier years, dividends were much higher than repurchases, right? But as we move along the time, we can see repurchases are much higher than the amount of dividends. Okay, so you can see that over the years, the amount of cash that's been distributed, and both in the form of dividends and repurchases, has increased tremendously. So now firms pay a lot more, right? You can see, both of these bars are increasing. Both the dividends are increasing and repurchases are increasing. But the rate at which dividends have grown is much lower as compared to repurchases. Now, a lot of firms pay cash back to shareholders in the form of repurchases, right? So the the yellow line shows the percentage of companies with buybacks, and the darker line represents the percentage of companies with dividends. So what's happening to the darker line? You can see that over the years it's going down. It's going down and then it got up again, right? But what's happening with the blue line? Percentage of companies that pay that do buybacks. So it has increased, and from 2014 onwards, the percentage of companies that buy back shares is greater than the percentage of companies that pay dividends. What? Okay, can you hear any sound? No. Okay, good. Right. Any questions so far? No. Good. Okay, so what's the conclusion of this part? So conclusion on payout practice. So we have seen that over the years, repurchases have gained a lot of momentum. All firms are now choosing to pay back cash in the form of share repurchases. So there are substantial, the amount of money that's being distributed, both in the form of repurchases and dividends, it's a huge amount of money, right? Okay, so they're substantial. So the payouts are substantial in aggregate, and especially so for firms that make them, repurchases have become more popular and more important as a result than dividends as a way of distributing cash to shareholders. Right. Okay. So now we know what firms actually do, right? What has happened to dividends and repurchases. So based on this evidence, right? Based on this evidence, what do you think, which one would be more beneficial for shareholders or for the firm? Given that repurchases have increased so much, right? So you would assume that there must be some advantage of using repurchases as compared to dividends, right? That's why they're increasing, right? But is there actually an advantage of using dividends, using repurchases as compared to dividends? So